Yeah. Guys, we do have a trade deal today, actually. It's between the UK and India, but that's a different story. Let's turn to the broader markets today. The S&P and the Dow snapping this 9-day win streak as tariffs continue to weigh on the markets. Joining us here at Post 9, talk about his outlook for the market is David Kostin, Goldman Sachs chief U.S. equity strategist. David, welcome. Good to have you in a different chair today.
Yes.
It's Sarah's chair.
Co-anchor.
What do you make of, we were talking this morning about the number of companies that have either pulled or declined to give a full year guidance. What's that trend look like right now?
Well, the trend is a little bit less than is normally the case. And normally you get something like 40% of companies increase the guidance in the subsequent year looking forward. And now you're getting much fewer companies are actually leaning into that and raising their forecasts. So like 57% of companies are just reiterating the guidance that they had already previously given. And basically what they're saying is on a baseline expectation, without the big impact of tariffs or without a scenario of a recession, basically they're holding the fort. But I don't know if they actually believe that internally. All the conversations we have with corporates are a lot of concern on what's taking place. And the market, the equity market, is pricing really the very best outcome that we anticipate in our baseline forecast.
Have we gone from pricing the worst to the best in a hurry?
Pretty much, Carl. You basically sit that reverse in a matter of a week or two. And so I think the expectation that the number one question we get from clients is the U.S. stock market trades at 21 times forward earnings. In an environment which is historically a pretty high multiple, in an environment where there's maybe 50% probability that there's a recession in the next 12 months.
Or 45 in your case.
Jan Hatzius, our chief economist, assigns a 45% likelihood of recession. So therefore, the baseline expectation is we do not have a downturn. But in that environment, which is pretty optimistic, the earnings are going to decline, or earnings will grow by around 3%, and you have a valuation in the market that's a little bit lower than today. Earnings will grow, and still yet an index that maybe is 4% up from here in the next 12 months. So not a lot of upside from these current levels. On the other hand, if you have a scenario where you do have a contraction in the economy, then you have a scenario where the S&P 500 index-wise should be closer to, say, 4,500. So we're at 5650 versus 4,500, and if you probability weight that outcome, you'd be something in the vicinity of 5,000, something like that, around numbers.
Right.
And so that is the fundamental debate and the discussion point. I spent a week in London last week. All the conversations with fund managers are really about this dynamic. What's priced? And when we look at cyclical stocks relative to defensive stocks, it would suggest, in fact, that the economic outlook that the stock market is implying is something above 1%. And the baseline forecast we have is a little bit lower than that.
I wonder if you can speak to something that Hatzius writes about today, and that is the lag from the soft data survey work to the hard data. He argues it's not uncommon in event-driven outcomes to see, you have to wait.
That's correct. And that's where the uncertainty rises in the market volatility. So the expectation is that the soft data, some of the survey-based economic data, that tends to show weakness pretty quickly after the event, maybe in the next first 30 days, for 30 to 60 days, whereas the hard economic data probably shows weakness in the 60 to 90-day period, kind of a couple months later. That would translate, if you will, sometime into June/July. That is the period of time you'd see a lot of weakness. And that is the debate. So we're sitting here today in the early part of May, so we're still another 60 days, couple months of where we're waiting. And in that environment, if there's some kind of a trade deal, maybe we can avert the potential contraction.
Right.
But the stock market is pricing that right now, in our opinion. They're pricing the outcome, the right tail, which is fine. But the risk is not necessarily priced in the market of potential downturn.
In the meantime, Palantir notwithstanding, what do you make of Mag 7's ability to so-called come to the rescue last week?
Well, I think the thing that is most surprising to most portfolio managers is the fact that the downturn in those stocks occurred in February and March, before the whole tariff debate ensued. And it was really a consequence of the DeepSeek announcement and the question of the amount of capital spending that all of the Mag 7 companies are engaged in right now. And it's doubling from what it was 2 years ago. It was $167 billion 2 years ago. It's going to be $333 billion for those companies this year. That's an extraordinary increase, doubling in 2 years. And investors are starting to ask the question, what is the return on that capital? On the other hand, they've had big bounce back. But the typical stock, Carl, 493 stocks, the S&P 493, is actually up year to date. And so that's an important consequence. Yes, The Mag 7 has rallied. They were down 20%. Now they're down, basically low double digits,
right.
11, 12%. But that still leaves the idea that the broadening of the market, one of our key arguments for this year is a broadening of the market, more of an equal-weighted strategy as opposed to a cap-weighted strategy, likely to deliver better returns for portfolio managers.
And you're standing by that thesis for the full.
Retain that view.
David, good to see you as always. Thanks for helping us make some sense of the quarterly earnings season.